Hey everyone, welcome back to Corporate Decoder. Today H.N.O International Inc. HNOI just filed a Form 8K about a material definitive agreement, and I am seeing a lot of dilution potential. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just inked a deal that could bring in a lot of cash, but there is a real risk of it making existing shareholders own a much smaller piece of the company. So what is going on here? H.N.O International Incorporated, a company you might know in the specialty industrial machinery space, has announced a significant financing agreement. This filing is called a Form 8K, which is basically a report of major events that shareholders need to know about right away. The report details an equity purchase agreement signed on the 27th of April 2026 with Lambda Ventures LLC. Think of this as a flexible line of credit, but instead of cash, the company can ask Lambda Ventures to buy shares of H.N.O International stock. This deal allows H.N.O International to sell up to $30 million worth of its stock to Lambda Ventures over the next 2 years. The key phrase here is, right, but not the obligation. This means H.N.O International can choose when and how much stock it wants to sell under this agreement. It is like having an ATM for stock sales, but they control when they use it. How does this work in practice? The company can send what is called a put notice to Lambda Ventures. This notice tells Lambda Ventures to buy a certain amount of H.N.O International stock. There are rules though. Each time they ask for money, it has to be at least $25,000 and no more than $500,000, or twice what normally trades in a day. This prevents huge, sudden sales that could really shake up the stock price. Now here is where it gets interesting for investors. The price H.N.O International sells its stock at is not the current market price. It is set at 80% of the lowest trading price on the day before they send the notice, or 80% of the lowest price during a specific period. This is a significant discount. Selling shares at 80% of their market value is a clear sign of dilution. Imagine if you owned a piece of a pie and the company decided to sell more pie to someone else, and they paid less for their slice than you did for yours. Your slice is now worth proportionally less. As a thank you for agreeing to this deal, H.N.O International is giving Lambda Ventures 500,000 shares of its stock right away. These are called initial commitment shares, and it gets better for Lambda Ventures. Every time H.N.O International raises another $2.5 million through this agreement, they have to give Lambda Ventures even more shares. These are called fulfillment commitment shares. So not only does Lambda Ventures get to buy shares at a discount, but they also get more shares for free as the company utilizes the facility. If H.N.O International uses the full $30 million, that means there will have been 12 of these trigger events, meaning a lot more free shares will go to Lambda Ventures. This structure is designed to incentivize Lambda Ventures to fund the company, but it comes at a significant cost in terms of potential share dilution for current shareholders. On top of all that, H.N.O International is paying $10,000 for the lawyer fees associated with setting up this deal. Also, as part of this agreement, H.N.O International has to file a registration statement with the CC within 30 days. This statement makes it legal for Lambda Ventures to sell the shares they receive, both the initial ones and the ones they get as fees, to the public. This essentially ensures that Lambda Ventures can easily monetize their investment. This next section is important for understanding how these shares are being issued. It reiterates that the initial shares being given to Lambda Ventures are exempt from standard registration requirements, because Lambda Ventures is considered a sophisticated investor. They are stating that no widespread advertising or public solicitation was used to find Lambda Ventures for this deal. Finally, the filing lists the actual agreements as exhibits, like the equity purchase agreement and the registration rights agreement. Think of these as the full contracts that lay out all the fine print. Looking at this filing, it is clear that H.N.O International is facing a cash crunch and needs money to operate or grow. This deal with Lambda Ventures provides a pathway to get up to $30 million. However, the terms, particularly the discount on the stock price and the additional shares given as commitment fees, point to significant dilution for existing shareholders. Historically, companies that rely heavily on these types of equity lines often see their stock price under pressure due to the constant threat of new shares entering the market. For instance, companies that have used similar financing structures have sometimes ended up in a downward spiral, where each new funding round further devalues the stock, making it harder to raise more money at reasonable prices. It is a bit like trying to fill a leaky bucket with a small pitcher. A comparable situation might be seen in companies that, after taking on similar dilutive financing, have experienced prolonged stock declines, sometimes in the range of 50 to 70% over the following year as the market prices in the increased share count and the company's ongoing need for capital. The risk here is that management might use this facility too aggressively, or that the company's actual business performance doesn't improve enough to offset the dilution. The need for such a financing agreement also suggests that traditional lending or equity offerings might not be readily available on favorable terms. The biggest concern is the price at which the shares are sold. Selling stock at 80% of the lowest traded price means that for every dollar H.N.O International gets, they are giving away shares that were recently trading at a higher value. This practice can create a negative feedback loop, where the stock price falls because of the dilution, which then leads to even more shares being sold at lower prices in future tranches. What I am watching for is whether H.N.O International can achieve profitability or significant growth to make this dilution worthwhile for existing shareholders. Without a clear path to sustainable earnings, this financing could be a slow bleed. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.